Hey, what is going on, everyone? Colin here from moremoneymaintenance.com, here to talk about why investing is supposed to be boring. If you didn't get a chance to see our last episode, we talked about the wild ride that Dogecoin and GameStop was taking everybody on. Today, we're going to be talking about some of the consequences of hype investing, and alternatively, things that you can do to keep your money growing. So let's stop wasting time and jump right in. I saw this great article this past week with a headline titled, GameStop's stock rally is a financial lesson for kids. Investing is supposed to be boring. The article went into detail explaining how, while there were a few winners with the GameStop craze, many who jumped in on the hype lost a lot of money. This is not a very surprising fact. When I made last week's video, I was talking about how concerned I was that GameStop was at a staggering $325 a share, when 3 months prior, it was only worth about $11. Well, now, a week later, anybody who bought it at $325 a share lost about 80% of their money, simply because they had unfortunate timing. I'll admit that it was a very exciting time for a few weeks, but as the article stated, investing is not supposed to be exciting. And it makes sense, right? What part of reviewing financial statements, comparing business models, and reading about executive teams is fun? Just about none of it. Yet if you're buying shares of stock without doing that, then you're not investing. You're just making bets. Look, I'm not against making bets and having fun with the market. This often piques curiosity and drives people to learn more. But those who never learn the fundamentals of investing will never establish a financial foundation. Think about it. If we look at the data, only 29% of active stock fund managers beat their benchmarks in 2019 when we take into account their fees. The key word here is active. There's a difference between active stock funds and passive stock funds. Active stock funds are managed by Wall Street professionals who try to game the market by buying and selling stocks relatively frequently. They don't care as much about the company's fundamentals as they do about buying the stock low and selling it high. Passive stock fund managers, on the other hand, are those who take a long-term approach. They buy and hold for the long term and usually try to mirror some sort of stock index. For example, in our portfolio, we own VOO, which is a passive fund managed by Vanguard and is supposed to replicate the S&P 500, which is an index or a collection of the top 500 stocks in the country. In other words, instead of trying to buy and sell diamonds in the rough, passive funds buy solid companies with the goal of holding them for a very long time. Now let's apply this to a personal level. If you are somebody looking to make bets on which company will soar 500% next week, you're acting as an active fund manager. Yet only 29% of these managers actually hit their goal in 2019, and they're professionals who do this every day. So what are the odds of somebody brand new coming in and doing this successfully? I'd say it's pretty low. But with that, I'll circle back to my previous point that making bets is not all terrible. It gets people interested in building wealth. But just like active fund managers, this is not a sustainable approach. I personally believe that it's best to set aside only a small portion of your money to make bets with, leaving a majority to grow in stable investments. Why? Because math and logic are on my side. You might ask, how so? So consider this old riddle. Would you rather have $1 million or one penny that doubles every day for 30 days? If you picked the penny, you'd be left with $5,300,000, which is about 5 times as much as the first option. So my point here is that if you're as good as you think you are at picking the best stocks and selling them at the right time, then you'd be able to turn a very small amount of money into a very large amount in no time. It only took the magic penny 30 days. Meanwhile, the majority of your money was off growing and compounding in a sustainable investments, which means that regardless of if you quadrupled your betting money or lost it all, you still now have an established financial foundation. So I get it. It often is the hype and thoughts of getting rich quick that grabs your initial interest into the markets. But the faster you get over that and start taking the boring approach to investing, the faster you'll start to build that foundation. And you don't need to be reading financial statements either or doing any kind of company analysis or anything like that. You don't need to do that. That's exactly what this series is about. There are funds out there that do all the research for you. All you have to do is buy the fund and hold it for as long as you can. So don't believe that the hype investing is dangerous? Well, if you bought GameStop the day of my last video, you would be down 80% on your money. But if you bought any of the portfolios that we're reviewing, or any other index fund really anywhere, you'd be up anywhere between 3 and 5% for the week. The people who made the real money with GameStop had owned it for months or years. They bought it when it was extremely low and took advantage of all the hype to sell it when it was artificially high. I'm not saying that you can't do this, but 3 months ago, who cared about GameStop? Obviously, the answer is almost no one, because very few people owned it until all the hype pushed it up. The only way to make money in this kind of situation is to buy the stocks before anybody cares about them, and then sell them when everybody else jumps in. But what stock is next? That's the million-dollar question. What stock is going to go through what GameStop just went through? Obviously, this approach seems pretty simple, but figuring out what the next stock is that's going to take off is near impossible. But if you buy funds like we have in our portfolio, you invest your money into hundreds or thousands of stocks, which means you get to be a part of the ups and downs for all of them. Owning funds takes away a lot of the guesswork that comes with picking the next big thing and gives you as the investor the power. Is it boring? Yes, of course it is. These funds aren't going to skyrocket 400% next week. But at the same time, they're not going to drop 80% next week either. And if they do, we can almost guarantee that they're going to come back. During the most recent market correction last March, we saw our most risky fund drop by about 30%. Obviously, that's a huge hit. But since it was a basket of stocks and not just one company, the successful companies helped outweigh the poor performing ones, which led to a net positive that's almost doubled in price since then. My point here is that investing in hype has consequences. And while you may think that you're subjecting yourself to a quick path to wealth, you're likely only risking losing the money that you have invested. Now, many of you refuted this by saying that you knew that you were going to lose the money, and the only reason why you invested in it to begin with was just to get back at hedge funds. But I don't think that's a good approach either. Logically speaking, if you're an everyday person with an average salary, what does you losing your money do to make society better? The billionaires will still have billions of dollars to keep doing their thing with, yet somehow the extra money that you worked hard for was lost in a failing company out of principle. And with that, the hedge funds have caught on to your strategy. Now there's rumors that they have bots scanning for frequently mentioned stocks on Reddit to take advantage of any of the hype ups. So logically, I just don't get why you'd be willing to subject your money to loss. And honestly, when has destruction ever benefited society? I get that you wanted to go after the hedge funds, but destruction is destructive. Every minute that you spend planning somebody else's demise is a minute less that you spend building yourself up. Regardless of if it was to get back at the hedge funds or to make a quick buck, everybody was investing at GameStop because of how much hype was around it. And ultimately, it was the hype that led to the loss of a ton of money. So either way, investing in the hype has its consequences, no matter what your reason is. But there are alternatives. And that's the point of this series, to actually invest into those alternatives and to show through firsthand experience that the stock market is not all speculation. While I may have missed the exciting ups and downs of GameStop, I was able to steadily grow my money through broad investment into the stock market. I started this account on December 28th of 2020 with $500 and have invested $125 a week every week since then. Now here we are over a month later, and we're sitting on nearly $1,285, and of which $36 is profit. Now the point of this series was to be relatable, and not everybody has $500 to drop on an investment or $125 a week to be consistent with. So I broke this down a step further. I created 5 different portfolios that cater to different audiences, all of which received an initial $100 investment and then have been receiving $25 weekly contributions ever since. This way, even those who don't have that much spare money at the moment could witness how powerful that small bit could be with the power of compounding and consistency. If we check out how we've performed over the last month, we see that we're faring a lot better than anyone who has just left their money in a savings account. I mentioned in a previous video that the national average interest rate on a traditional savings account is currently 0.05%. This means that if you saved up $5,000, after an entire year, you'd have only earned $2.50 in interest. Yet as you can see with our summary chart here, $250 invested into our best performing portfolio would have already earned you $11.58. In other words, that $250 investment after 6 weeks earned you 363% more than what you would have been paid by $5,000 held in a savings account for an entire year. Even if we look at our worst case, $250 invested into our worst portfolio for 6 weeks would still have earned you 77% more than $5,000 in a traditional savings account. In my opinion, though, the best way to look at this is with an apples-to-apples comparison. We do that by comparing our entire investment account's earnings to if we put the same amount in a traditional savings account. So far, after 6 weeks, our portfolio has had $1,250 invested into it and has earned us $35.88. If we look at a savings account with $1,250 in it, it would take an entire year just to earn 63 cents. This means that after 6 weeks, our investment account has earned 5,641% more than a savings account would for an entire year. That math right there is exactly why I don't care about catching hype stocks. Many people don't have any investments at all. It's just sitting in a checking account paying nothing, or in a savings account paying virtually nothing. So instead of trying to go from 0 to 100, I advocate that everybody start slow. And as I mentioned before, if you need a little bit of play money to have fun, that's perfectly fine. I do that. But the bulk of your investments would fare much better in a steady growing portfolio rather than on speculative bets. And for those investors out there who just really can't handle the slow pace, it's just really not for them, at least take a look at this portfolio right here. This aggressive growth portfolio is just that. It invests 98% of its assets into Triple Q, which is an ETF that tracks the NASDAQ 100. This fund is heavily weighted in large cap tech stocks, which simply means that a lot of the fund is allocated to big name tech companies. Now, while I'd argue that this portfolio is very risky in itself, it's still a better alternative than getting your investment advice from Wall Street Bets. I mean, bets is literally in the name. See, if you look at the 5-year performance of our aggressive portfolio, it's brought in about a 230% return. So while it's not as exciting as placing bets on stocks, I'd still say it's pretty fascinating. And again, I'll caution that the less diverse you are, the more risk that you face. And in our case here, 98% of the portfolio being in Triple Q, while 2% in treasury bonds, this fund carries a lot of risk. Yet as they say, with more risk comes more return. This aggressive portfolio is our top performer since inception, and has a 250% greater return than our worst portfolio. So if you're someone that just can't help but subject your money to risk, at least this option will spread your risk out among 100 companies. Personally though, I think my best bet is exactly how I have the entire account set up. I hold some aggressive portfolios and some very diversified portfolios, and this way, I have safe money during bear markets and money that's exploding during bull markets. And if I look at the return of our entire account over the last 5 years, we see that it's sitting just shy of 100%. This means that I would have doubled my money if I invested exactly 5 years ago. So while hype stocks may come and go, a solid diversified portfolio will always be there for you, no matter how boring it is. So before we close out today, here are a few key points from our video. First, investing is really supposed to be boring, and if it's exciting, there's probably something wrong. Second, a penny that doubles every single day will be worth more than $5 million after only 30 days. This means that you only need to set aside a small amount of money for your speculative trading. And if you're as good as you think you will be, it'll grow to massive amounts very quickly. And the rest of your money should be housed in boring, typical investments. So if you happen to just not be as good as you think you are, the rest of your money still has an opportunity to grow exponentially over time. And finally, our boring approach to investing still earned us 5,641% more in 6 weeks than what we would have earned on it for an entire year if it was just sitting in a savings account. So that's a wrap for my 5th video ever. If you learned something or received value from it in any way, please do the channel a solid and light up that like button. If you have any questions or insight about anything that we talked about today, drop your thoughts in the comments below. And finally, if you're as interested in financial literacy as I am, please subscribe to get the latest new content, and remember to check in next time to conduct some more money maintenance.